Hello and welcome to Charting the Markets on Wednesday, the 31st of May 2023, the last day of the month. And what a day it is. We have the US debt ceiling debacle still going on, with lawmakers trying to push through a deal before the 1st of June. Having said that, the US Treasury has now managed to push back the date of a possible US debt default happening to the 5th of June. So there may be a little bit more leeway than was first thought. Despite that, we'll have to see whether all the different hurdles can be overcome with regards to Congress agreeing to the debt deal, the ceiling raising that was negotiated between President Biden and the House of Representatives Speaker Kevin McCarthy last weekend. So overnight, Asian markets didn't take these ongoing wranglings in the US lightly, with Asian markets coming off. And another reason they did so was also because in China today we had worse than expected PMI data out, showing that the country is actually not growing as quickly as was hoped, and that manufacturing is actually slowing down in the second biggest economy in the world, in China. And when you look at the FTSE 100, we can see here that we have been declining over the last couple of weeks and accelerated to the downside, and are now for the first time since March trading back below the red line here, the 200-day simply moving average, 7,531. And this is because of the makeup of the FTSE 100, which includes a lot of commodity and oil shares. With the oil price coming off and also a lot of other commodities coming off, this has had a negative impact on the FTSE 100, which continues to decline, and as I just said, is now trading below the 200-day simply moving average, which technically does not bode well for those people who are still long the FTSE 100. And right now, we'll have to see whether we can hold around the 200-day simply moving average on a daily chart closing basis, in which case we may still be all right. But if we were to slide through today's low, which was made at 7,461, the odds are pretty high that we will retest the early January low at 7,412. And then if that were to give way, we've got another support area coming in at the 24th of May low at 7,331, and also the December low at 7,296. So these are potential downside targets for the FTSE 100 in case of it not managing to hold around the red line, the 200-day simply moving average. Now, there may be some slight hope. We can see here we haven't made a lower low yet in the RSI, confirming the latest low we've made today. And if we were to bounce off today's lows and perhaps rise back above the 200-day simple moving average, it is possible that we could see a higher low on the relative strength index. That is to say, on the RSI, we could see some positive divergence, which could then perhaps lead us to recover again. But for this to be the case, we would have to take out Monday's high at 7,660. So that is really the line in the sand for the bulls. Provided we stay below there, the FTSE 100 still looks short-term bearish. Now, if we move on to Germany, we can see here that the German DAX 40 contract has also come off its high made last week. In mid-May, we made an all-time high at 16,333 on this daily financial bet. Since then, we retested the early May lows, but have held slightly above those at 15,723 last week, a level which was practically retested earlier this morning. And also the orange line here, the 55-day simple moving average at 15,714. So key support for the DAX is still this 15,659 level on the daily financial bet, the early May low, because if we were to fall through there and close below that level on a daily chart closing basis, then to me that would indicate that we formed a top and that we could slide over the next few weeks back down towards the 15,000 mark. And it is also, from a statistical point of view, quite likely that the month of June is not going to be a very, very good month, because in over 50% of cases, June tends to be a negative month for equity markets in general. But we'll have to see what happens. We'll have to see whether this support holds or not. As long as 15,659 does hold, though, we may still see a recovery rally. But we would have to take out Monday's high at 16,080 for us to resume our medium-term uptrend. Now, another market which has been hit very strongly by the weaker than expected PMI data coming out of China is the Hang Seng. And as you can see here, the Hang Seng is basically today, earlier today, basically traded in what some may call the bear market territory, basically saying that from its January high at 22,800 or so, the index has declined by about 20%. And year to date, we're actually down 10% on this index. And here we can see, provided we stay below the accelerated downtrend line, and more importantly, Monday's high at 18,859, further downside looks more likely than upside, in which case we could head back down again towards the November low, the late November low of last year at 16,813. So the Hang Seng really struggling and coming off, and it looks to me as if further downside is likely on this index. Now, the story is completely different with regards to the Nasdaq 100. As we can see here, the Nasdaq accelerated to the upside last week on much better than expected earnings from the likes of Nvidia, with its share price rising by 25% after those earnings and pushing the Nasdaq 100 to new one-year highs. And we basically went up on this daily financial bet to 14,530, a level last seen in April of last year. And then even here, short term, you can see we're forming several dojis. I mean, today we don't know yet because we're still trading in the overnight session at the moment, but it is possible that we may see some loss of upside momentum and perhaps a correction lower over the next few days. And that will obviously also depend on what happens with regards to the US debt ceiling. Now, in the FX markets, what we've also seen is a stronger dollar. The dollar continues to rally on those US debt ceiling wranglings with regards to or the two parties in the US, the Democrats and the Republicans, agreeing to raising the debt ceiling, and this being pushed through the US Congress, with some staunch Republicans trying to block that move. And we'll have to see whether this negative sentiment that is coming out of the US and impacting global markets in general, not just on equity indices, but also with regards to currencies, and whether that can lead to further flight to quality flows into the US dollar. And here we can see the dollar basket on the daily financial bet. And as you can see here, I can even draw on an uptrend line here. We are clearly still heading higher, having slightly come off yesterday. We are heading into the end of the month with regards to this dollar basket touching a 2-month high, so heading back to levels last seen in mid-March of this year. So further upside is currently in store. The next upside target would be the mid-March high at 104.72. And then further up, we've got the red line here, the 200-day simply moving average at 105.35, and then also the March high at 105.51. These are potential upside targets. And these are really the key resistance areas for the long-term trend with regards to the US dollar. Because if we were to close above these highs, above the 105.50 area, on a weekly chart basis, then we would be forming a technical bottoming formation, which could then take us all the way back up to 110 or even higher. But we'll have to see whether that will actually happen or not, or whether we will simply falter once more and slide down again, as we have done over much of this year so far. But right now, short term, the dollar basket remains bullish, and short term does so provided we stay above yesterday's low, that is to say at 103.47. Above there, basically further upside is still in store for the dollar basket. And if you look at euro dollar, and as we all know by now, probably the euro makes up 57.6% of the dollar basket, you can see the inverse. The euro dropping to 2-month lows, and this morning having hit basically 106.59, a level last seen on the 20th of March of this year. And euro dollar looks as if it could head all the way back down again towards the March low at 105.16. So that is a possible downside target for this currency pair. Short term, we remain bearish, provided we stay below this 2-month downtrend line and the last reaction high, that is to say yesterday's high at 107.46. And as long as that's the case, further downside looks more likely than any upside being seen here short term. Now, euro sterling is quite similar, but here what we've seen is not just a decline, but also the currency pair slipping back to levels last seen in mid-December of last year. So further downside here in store for the euro versus the British pound. This despite inflation in France actually coming in lower than expected earlier this morning. And as you can see here, it's probably this currency pair continuing to come off on the back of further rate hike expectation being seen out of the Bank of England, and that pushing the British pounds perhaps higher. So what are the downside targets for euro sterling? Well, we've got a really good support area between the October and December lows, and that comes in around 85.80 and 85.48. So that would be the next pretty important technical downside area for euro sterling. And the bulls could only be back in control if we were to rise above the last reaction high, that is to say a high above the previous candle's high and the next day's candle's high, and that is to say the 23rd of May high at 87.19. So provided we stay below there, further downside looks much more probable than any reversal. Commodities have been impacted by the strong US dollar over the past 2 to 3 weeks, with several commodities coming off quite sharply. But there are also some, such as orange juice, which have hit new all-time record highs, and I'll talk about that later on. But first of all, I'd like to mention WTI, that is to say the oil price, because if you look at the daily financial bet of WTI, we can see here that yesterday we've had a 4% decline in the price of oil. That was on the back of Russia basically not adhering to its OPEC plus agreement of cutting its output. And basically this extra supply has led to the oil price falling. Also because of the largest oil importer in the world, China, basically this morning, earlier today, publishing its PMI data, which showed that manufacturing growth in in China is actually declining, and it came off much lower than expected, the PMI data for May there, and that led to growth worries with regards to China and to future demand being lower for oil, and that's why the price of oil is coming off at the moment. We've now slid through the $69.39 low from mid-May and are heading back down again, probably towards the $65 to $64 area. And as you can see here, we made the March and May lows, early May lows, in that zone and bounced off there every time. So we'll have to see whether that is the case again. But short term, given the sharp falls we saw yesterday ahead of this week's OPEC Plus meeting later on this week, we could see further downside here just by looking at the chart. That looks more probable than any reversal to the upside. Now, the gold price is kind of interesting because here we've seen the inverse. I mean, gold has come off since its early May high, but has now actually bounced off a long-term uptrend line. That's why I love technical analysis. If you go on to your daily financial bet here, you can see that we had a uptrend line drawn in since November of last year through the March lows, and right bang on cue, we tested that level earlier yesterday, went down to $1,933 per troy ounce and then bounced off that line. And in doing so, actually closed on this 1-month resistance line, and this, because of inverse polarity, is now acting as a support line, currently at today's low at $1,954 per troy ounce. And short term, the break of this trend line, the bounce of the more important longer term trend line, does mean that we may well retest the mid-April low of $1,970 and perhaps also the orange line here, which is the 55-day simple moving average at $1,989 over the coming days, provided we stay above this week's low at $1,933, which is a 2-month low. Now, last but not least, I'd like to mention orange juice. Orange juice last week rallied to a record all-time high at $2.87, and this was on the back of further worries about supply to do with orange juice. And as we know, I mean, the Florida crop this year has been the worst since the 1920s because of extreme weather, and also because of several citrus diseases which affected the production of oranges. And with Brazil also grappling with several issues with bringing their oranges to the market, the price of orange juice rallied again over the past coming weeks, but has come off yesterday by over 3%. So to me, that may indicate that we are short-term at least forming another top here. And also, if you look at the latest price high at $2.87, that was made slightly above the April high at $2.80. But if you look at the relative strength index here, you can see that we actually didn't form a new high compared to the April high. So yes, the price has made a higher high, but the relative strength index is forming a lower high, and that is called negative divergence, and does point towards short-term at least a correction lower being seen. So where could that take us? Well, we have the 1-month uptrend line, which currently comes in around to $2.67. And then we have also the price gap from last week here between $2.67 and $2.64. So that's a possible downside target, because price gaps tend to get filled unless they're breakaway gaps or some other forms of gaps, exhaustion gaps, etc. But in this case here, it is possible that we're going to close this price gap. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is at Axel R_IG.